The global economy is in constant flux, a complex dance of capital flows and investment decisions. Recently, China and Japan have been quietly making a significant move. They are reducing their holdings of US Treasury bonds, a bedrock of the global financial system. This shift has prompted analysts to dissect the motivations and potential ramifications. For decades, China and Japan have been among the largest holders of US debt. Their purchases helped finance the US government's borrowing needs, keeping interest rates low. This mutually beneficial arrangement appears to be shifting, raising questions about future dynamics. The reasons are multifaceted, involving economic, geopolitical, and financial factors. Understanding these motivations is crucial for grasping the potential implications for the global financial system. Is this a temporary blip or a harbinger of a more profound realignment in the global economic order? Only time will tell, but the implications warrant close scrutiny from policymakers and investors. To understand why China and Japan are reducing their US Treasury bond holdings, one must delve into the intricate workings of their respective economies. Both nations have undergone significant economic transformations in recent decades, and these internal shifts have influenced their investment decisions on the global stage. China, once a predominantly agrarian society, has become a global manufacturing powerhouse, its economy driven by exports and investment. This remarkable growth has led to an accumulation of vast foreign exchange reserves, a significant portion of which has been held in US Treasury bonds. However, as China seeks to rebalance its economy towards domestic consumption and reduce its reliance on exports, it has become less dependent on accumulating US dollar reserves. Japan, on the other hand, faces a different set of economic challenges. An aging population and sluggish economic growth have plagued the country for years. The Bank of Japan has implemented unconventional monetary policies, including negative interest rates, to stimulate growth. These policies have reduced the attractiveness of holding low-yielding US Treasury bonds for Japanese investors. Furthermore, both China and Japan are increasingly looking to diversify their foreign exchange reserves away from the US dollar. This diversification strategy aims to mitigate risks associated with having a large exposure to any single currency, particularly as the US dollar's dominance in global trade and finance gradually diminishes. Geopolitical considerations shape the investment decisions of nations. As the global balance of power shifts, so do the financial calculations of major players like China and Japan. Their decisions to reduce US Treasury bond holdings reflect broader geopolitical trends and strategic considerations. The rise of China as a global power has led to increased competition with the United States. Trade tensions, technological rivalry, and security concerns strain the relationship between the two countries. China's reduction of US Treasury bond holdings aims to reduce financial dependence on the United States. Japan, a close ally of the United States, navigates a complex geopolitical landscape. China's assertiveness in the Asia-Pacific region raises concerns in Tokyo, prompting Japan to bolster its defense capabilities. Japan also recognizes the importance of maintaining stable economic relations with China. Japan's reduction of US Treasury bond holdings diversifies its investment portfolio and reduces exposure to US-China rivalry risks. Beyond the specific economic and geopolitical factors driving China and Japan's decisions, a broader trend is at play: the diversification of global investments. As the world becomes increasingly interconnected, investors, both public and private, are seeking to spread their risks and explore new opportunities beyond traditional safe havens like US Treasury bonds. Emerging markets, with their higher growth potential, have become increasingly attractive to investors. China and Japan, with their vast foreign exchange reserves, are directing a portion of their investments towards infrastructure projects, natural resources, and other assets in developing economies, seeking higher returns and reducing their reliance on the US dollar. This diversification trend is further fueled by the evolving landscape of the global financial system. The rise of alternative reserve currencies, such as the euro and the Chinese yuan, provides investors with more options to park their capital. Central banks around the world are also diversifying their foreign exchange reserves, reducing their dependence on the US dollar and creating a more multipolar global financial system. For China and Japan, diversification is not just about seeking higher returns. It is also about enhancing their own financial security and reducing their vulnerability to fluctuations in the US dollar. As the global economy becomes more complex and interconnected, diversification is no longer just an option. It is a necessity for any country seeking to navigate the uncertainties of the 21st century.